Heya, cryptozens. Tonight's stories. EU lawmakers choose anti-privacy. BNY Mellon tapped to custody Circle's USDC. 30% crypto tax voted into Indian law. It's 10 p.m. Pacific time. The date is March 31st, 2022. Welcome back to the Crypto Overnighter. I'm your host, Nick. The cover model for this podcast is text, and together we take on a nightly look at the crypto, NFT, and metaverse space and the industry that surrounds it. We bring you new stories on familiar topics. And keep in mind, nothing in this show should ever be considered financial advice. So, the SEC issued a little bit of guidance today. That guidance, as it applies to crypto, has two parts. One, any companies that hold crypto should list it as a liability. And two, those holdings should be disclosed to the shareholders. Okay, so it's a thing. There are rules in accountancy for safeguarding traditional assets when you're holding them for a customer. At present, there is no explicit standard for setting safeguarding practices for cryptocurrency. Additionally, different companies have different approaches. So why should crypto be listed as a liability? The SEC said it's because there are significant technological, legal, and regulatory risks associated with safeguarding crypto assets. They wrote, quote, "The technological mechanisms supporting how crypto assets are issued, held, or transferred, as well as legal uncertainties regarding holding crypto assets for others, create significant increased risks, including an increased risk of financial loss." As far as disclosing the holdings to shareholders, that makes total sense to me. They should let their shareholders know about each separate crypto asset and whatever security concerns are around those assets. In the meantime, U.S. regulators still haven't signaled how they're going to treat cryptocurrencies. Broad sweeping legislation around crypto is still being introduced into Congress frequently. They are still deciding what the rules are for banks and how they manage other people's digital assets. Now, before we get into tonight's stories, let's take a quick look at the markets. At the time of writing, the global crypto market cap is $2.09 trillion. That's down 2.64% in the day. The top 5 cryptos by market cap are Bitcoin down 3.5%, Ethereum down 3.3%, Tether, Binance Coin down 3.62%, and USDC. The global NFT market cap is up over $10.15 billion. That's up 8.42%. The top 5 NFT collections on OpenSea by sales volume are Azuki, and they just had some sort of an airdrop, I've heard. Bored Apes, CloneX, Cyberbrokers, Imposters, Genesis Aliens. Now keep in mind, some of these collections have very volatile prices, so do your own research. EU lawmakers choose anti-privacy. Disappointingly, EU lawmakers chose against privacy and voted in favor of a harsh set of regulations instead. They voted to take on a series of measures that seem custom designed to destroy innovation and demolish privacy. The committees in question were the Committee on Economic and Monetary Affairs and the Committee on Civil Liberties, Justice, and Home Affairs. Legislators hoped to ensure traceability of transfers between crypto service providers and so-called unhosted wallets, so they'd better be able to identify possible suspicious transactions and potentially block them. Some of these regulations changed the threshold for reporting crypto payments. Currently, the EU's anti-money laundering requirements apply to conventional payments over €1,000. So they're trying to extend those guidelines to the crypto sector, except they're not. What they did was they scrapped the floor on crypto payments. That means payers and payees of even the tiniest crypto transactions will be identified. This includes unhosted, non-custodial wallets. And they're also talking about any unregulated crypto exchanges won't be able to connect to the conventional finance system. This means unregistered or unregulated crypto exchanges won't be able to act as fiat on-ramps or off-ramps. That's all but crippling for an exchange. It also means that your unhosted or self-hosted wallet, the financial fiat on-ramps and off-ramps won't be available to them either. Now, why are they getting rid of the threshold for reporting on crypto transactions? The claim is that digital payments can easily circumvent this limit. I would agree that the same thing has proven true to be for conventional payments, and that's been the case for centuries. Back in December, the Slovenian finance minister said it was an important step to, quote, closing the gaps in our financial systems that are malevolently used by criminals to launder unlawful gains or finance terrorist activities. Opposed to many of these changes, including what they call a de facto ban of self-hosted wallets, is the center-right European People's Party, or EPP. Markus Ferber, acting as their spokesperson, reacted via email on Thursday. He wrote, quote, such proposals are neither warranted nor proportionate. With this approach of regulating new technologies, the European Union will fall farther behind other more open-minded jurisdictions. Now, another thing that was discussed was a legal proposal that would stop transfers made to what they call non-compliant crypto service providers. This would include any operating in the EU without authorization. Now, it's going to be interesting to see how things come out. Coinbase was one of the industry players that object to these rules, as well as legal experts. They're concerned that the heavy-handed privacy violations could face legal challenges in court. In a tweet Wednesday, CEO Brian Armstrong, he warned that Coinbase would have to tell the authorities every time a customer transfers over €1,000 out, even to their own self-hosted wallet. On the company blog from Coinbase, Paul Grewal wrote, quote, if adopted, this revision would unleash an entire surveillance regime on exchanges like Coinbase, stifle innovation, and undermine the self-hosted wallets that individuals use to securely protect their digital assets. So, from here, the package must be agreed upon by both the Parliament and national ministers. Those will be the participants in the EU Council, which will vote to determine if it becomes law or not. BNY Mellon tapped to custody Circle's USDC. BNY Mellon is the world's largest conventional custodian. They have more than $46 trillion in assets under custody. USDC is the second largest stablecoin. They have a market cap of $52 billion. BNY Mellon has spent a little while getting ready for work just like this. Last February, BNY Mellon announced that they were creating a digital assets unit. March of last year, a month later, they announced that they had selected Fireblocks to be their digital asset custody partner. Roman Riegelman is the head of digital at BNY Mellon. He said, quote, we are at a point in the evolution of our industry where the digitization of assets is presenting new and exciting opportunities to a broad range of market participants. Our goal, as a custodian for USDC reserves, supports the broader marketplace and brings value to clients founded on our role at the intersection of trust and innovation. As far as Circle goes, they're still working on that SPAC deal I told you about a while back. $9 billion valuation on that one. That was the deal with Concord Acquisition. That valuation with Concord is double their 4.5 valuation last July. And then there's the whole DeFi lending issue. BlockFi just got hit with a huge fine a little way back, and that's because the SEC considers most crypto lending to be a security. They said BlockFi was offering securities without the appropriate permission, so they got hit for $100 million in fines. And frankly, it's my understanding that Circle is still working on becoming a bank. But I don't think that's where this move is coming from. Think about Tether. Tether also got fined by multiple regulators. They weren't hit for securities, though. No, they were fined because they said Tether was fully backed when it wasn't. That's why this Mellon deal is a big thing. They went with the biggest custodian bank, which helps Circle's gravitas. In the beginning, you see, Circle relied on commercial paper to back USDC, and they took a ton of flack for that, perhaps because of what was going on with Tether. But at any rate, they changed up their mix. They worked it down to the point where their backing was nothing but bank balances and treasuries. Jeremy Allaire is CEO and co-founder at Circle. He said, quote, "Building trust, stability, and resilience in the digital asset economy is foundational to Circle's mission. As we continue to see exponential growth in USDC, the opportunity to work with BNY Mellon is one way we build bridges between traditional finance services and emerging digital asset markets without sacrificing trust." And this actually seems to fit in nicely with BNY Mellon's overall goals. They invested in R3 in 2015. Later, they joined the Marco Polo network. That's a group of financial institutions that want to use blockchain technology for international transactions. They also invested in HQLAX, a firm that runs on R3 technology. 30% crypto tax voted into Indian law. So it looks like what they've done is base their crypto law off gambling and lottery ticket wins. That's the same tax rate. And those tax rates are set to go into effect April 1st. Now, I've reported quite a while ago that this was coming. And at the time, some Indians were cautiously hopeful that their government would take their property and property rights seriously. So this was all in the Indian Finance Bill 2022. And that bill, with its 30% crypto tax rules, was voted in on Thursday. That was done by the upper house of Indian Parliament, and this approval came a week after the vote in the lower house. So this bill was pushed forward with the 2022-2023 budget session. That was in January. It was at that point that the 30% crypto tax was put into place for digital asset holdings. Painfully, traders cannot offset their losses against their profits. And on top of that, each trading pair will be considered separately for tax deductions. And on top of all of that, they're also throwing in a 1% tax deduction at source on each trade. This bill has been looked at and judged by various experts, traders, and exchange operators. And nevertheless, the government continued with their regressive approach without taking any input from stakeholders of their crypto ecosystem. And then there's the shade that's being thrown by the Indian government. A lot of Indians are upset that the government is equating the crypto market with gambling. And folks, this went through pretty quickly by my estimation. It was finalized and approved within 2 months. So far, despite years of assurances, the finance ministry has yet to offer a regulatory framework. Many Indian crypto entrepreneurs are concerned about the impending brain drain from the country. They feel like traders will use decentralized exchanges and foreign platforms for their trading needs. That's rather than building and innovating in India. And that's going to do it for us tonight. Thank you so much for joining us. I really appreciate it. Okay, so tell me what you think. Would you list crypto holdings as a liability for a company? I mean, I get what they're saying, but it seems unfair. They're called assets. The digital nature shouldn't change anything. And just because they haven't come up with a concrete set of rules for safeguarding digital assets doesn't mean they should be a liability, in my opinion. But that's the same kind of real versus digital fight as like in the Indian tax story and the European Union story. They're both not treating digital the same as real. I feel like that's the right thing to do, but I could be wrong. You, tell me what you think. Send me an email at crypto.overnighter@gmail.com. That's crypto.overnighter@gmail.com. Oh, and give my other podcast, Crypto in 5 Minutes, a listen. We're up to 39 educational podcasts, 5 minutes to explain one concept in crypto. And, as always, may peace reign.